When you buy stock, you buy ownership in a company. Stock, which is also referred to as shares or equity, represents a piece of ownership in a company. Publicly traded stocks can be bought in the stock market. Privately held stocks are available to a relatively small number of people or family members who own all the stock available. When a stock is created, the underwriter, which is a firm such as an investment bank that helps other companies raise money, turns the company from a private enterprise into a public firm. So first, an entrepreneur has an idea for a new product or service. Then, the business expands and is funded by loans and private investment. The business then continues to grow and seeks fundraising with an underwriter. Then it becomes incorporated and they begin selling shares in an initial public offering or IPO. Most underwriters use this initial public offering or IPO process to raise money from investors worldwide. After the stock is initially sold in the IPO market, investors seeking to make a profit can buy and sell the stock to other investors in the secondary market. A bid price refers to the highest price a buyer will pay to purchase a specified number of shares of a stock at a specific time. An ask price refers to the lowest price at which a seller will sell a share of stock. The bid price will almost always be lower than the ask or offer price. The difference between the bid price and the ask price is called the spread. In practice, the spread can be large, but it's usually pretty small. The spread is the profit that's earned by the securities dealer or stock dealer who enables the buy and sell transaction. Investors buy and sell stock through stock exchanges, which are organized markets where buyers and sellers conduct stock transactions. Owners are entitled by law to share in the profits of the firm. The firm's investors also appoint, through open elections, the managers of the company. Stocks are an asset that have the potential to produce income. For example, if an entrepreneur sells one cupcake, let's say, for $2, this is the gross sale. If that entrepreneur has $1.90 in expenses, which would be the ingredients, the labor, the rent, and the taxes for the cupcake shop, those expenses reduce the gross sales value. And so that one cupcake that's sold for $2, but it has $1.90 in expenses, would produce a net profit of 10 cents. So our net profit is equal to the gross sales minus expenses. So let's say our entrepreneur sells 10 million cupcakes. That's what it would take at a 10-cent profit per cupcake to generate $1 million in profit. So for a net profit of $1 million, if 1 million shares were sold in the IPO, the firm's earnings per share is $1 per share. So again, we had gross sales of $2 per cupcake minus $1.90 in expenses per cupcake gave us a net profit of 10 cents per cupcake. If we sold 10 million cupcakes, then that would give us a net profit of $1 million. If we divide that by the total shares in the market, which is 1 million, then our earnings per share is $1 million in net profit or earnings divided by 1 million shares, or $1. There are two ways to make money by owning stock. The first is to buy shares of stock in a profitable firm, hold the stock for a period of months or years, and then resell the shares at a higher price. The second way to make money owning stock is to receive earnings in the form of dividends. Stock prices over time move up or down as the anticipated profits of a company rise and fall. The difference between the sale and purchase price of a stock is known as a capital gain. However, if the stock price falls over time, selling it will produce a capital loss. One purpose of stock markets is to provide an honest and open place where investors can buy and sell shares of stock, which provides liquidity for buyers and sellers. Some, but certainly not all companies, distribute a portion of their earnings, which would be from current or retained earnings from prior years, to their shareholders. Dividends can be in the form of cash, additional stock, or other property. Dividends are typically paid every 3 months or 4 times a year. So let's go back to our cupcake company example. Let's say that cupcake stock is now selling for $13 per share. If the company pays out 50% of their earnings per share, remember earnings per share was $1 in our example, that means that they're going to pay out 50 cents per share. So if each share is now selling for $13, if you receive a dividend of 50 cents per share, you will earn a 3.8% return on your investment, because that would be 50 cents divided by $13. This is called the dividend yield. Stocks focused on stock price appreciation are called growth stocks. Stocks that pay out a large portion of earnings in dividends are called income stocks. Stocks that provide shareholders a combination of stock price appreciation and dividends are called growth and income stocks. One way to get started with buying stock is to purchase shares in companies using a direct stock plan. These plans, offered by thousands of companies, allow you to purchase shares in firms with little or no transaction costs. With a direct stock plan, the company will purchase or sell shares to you at specific times, sometimes daily, weekly, or monthly, at an average market price. Additionally, almost every company that pays dividends allows shareholders to reinvest those dividends in more shares through the company's dividend reinvestment plan, or sometimes we call it a DRIP. A DRIP allows you to put the power of compound interest to work by purchasing more shares of stock every time a dividend is paid.